Just a reminder to everybody, we're here for Susan G. Komen today. If you're watching us on YouTube, there's a donate link next to the video or under the video in mobile. If you're watching us on Twitter and LinkedIn, you can go to YouTube and you can donate. If you get any value out of what we're doing today, you're about to get some breadcrumbs here. So if you get any value out of that, please do donate. It's an awesome cause, and it's why we're doing all this today. And with that, Cem, thank you for joining us.
Hey guys, good to be here. I just want to say my little bit about that as well. Obviously, for those of you that don't know, I lost my wife about a year and 3 months ago to cancer. Just want everybody to know, like, there is no higher cause, right? Amount of pain and suffering that cancer causes in this world. It's something that we are making great strides towards. So hopefully, if we have been able to help any of you over the years, any amount, $10, $20, $50, whatever, it's such a worthy cause and much appreciated.
Yeah, we're so sorry for your loss, and it is a great cause, and hopefully everybody will donate if you can. Hopefully everybody will donate today as we go 12 hours to try to raise some money for them. So just briefly to intro you, I assume our YouTube feed is spiking uncontrollably right now, so we probably don't need to intro you, but we will anyway. You're the founder of Kai Volatility Advisors, and you have a very unique blend of being able to look at the macro, but also being able to look kind of in the short-term options world. And so I'm going to handle the macro today, asking you some stuff. And we actually have an expert who could ask you better questions on the options world than we usually do with Brent here. So I'll handle the first part talking about macro, and then Brent will dive in and hopefully we'll get some breadcrumbs for people. But first I just wanted to talk about where we are in general. I mean, you've been in the higher for longer camp for a long time. Inflation has definitely remained stickier than people thought. It's even spiked up a little bit recently. Like, where do you think we are? Can you just give us an overview of where you think we are in the macro landscape?
Yeah, I think it's important to zoom out. Jack, you and I have talked about this a decent amount, but so I won't tell that, I can go into 30 minutes just about the background of where the inflation is coming from. But the core point here is that populism is a reaction to 40 years of inequality. And that's a global phenomenon. This is not the first time this has happened. You can look back to 100,000 years of history. This is how things work. Stratification expands, in inequality, and then you get a reversal. And the reversals tend to be quicker than the expansion. The important part is labor. Youth is labor. And, the older generation, baby boomers in this case, are capital. And so what that ends up doing is it creates the cycles. And we're entering, we've been entering a cycle of populism. It really started about 12, 13 years ago with Occupy Wall Street and the Tea Party, right? But the millennials had not reached political dominance yet. And so they were not able to move the needle. It took the bringing of not just the left moving left with AOC and Bernie Sanders, but importantly Trump, to kind of bring the right left and eventually start passing massive fiscal stimulus and protectionism. Protectionism is tied intrinsically to populism. People care about countries care about their own people, but when we talk about capitalism, we rarely, protect our own companies. We're more profit seeking than anything with our corporations, and that creates globalization and whatnot. During those times, we are in a period of now protectionism and deglobalization. That tends to drive global conflict, higher labor costs, less expansive supply chains, all kinds of things, commodity scarcity. If you look back at the last time we had that period, 68 to 82, which I often reference, that's the last time we saw inflation go bottom left to top right, and interest rates do the same. We saw the same things that we're seeing now. We saw a Great Society program and massive fiscal stimulus. We saw, paired with that, a Vietnam War, a Cold War that was a massive expansion, and an OPEC crisis and commodity scarcity. Any of those sound familiar to anyone? Those sound like some things that we're seeing now. It's not a coincidence, right? And so once these things get started, they tend to feed on themselves. This is not a 1 or 2 year thing. This is not a 4 or 5 year thing. This is a 10 to 15 year phenomenon. And that creates structural inflation. Now, that doesn't mean we're going to have inflation every year that's going to be high. If you look at 68 to 82, inflation went to 7%, came all the way back down to 2, actually below 2%, 69 to 70, 70, 71. took back off when the Fed and stimulus came back to support a recession, a multi-year recession. That eventually took inflation to 12%. We then in 75, 76, created another recession, a deeper, more powerful one, and inflation came down to 4.5% again. Well, the next leg up was 22% at its peak, I believe. So this is kind of how it works. And in my view, if you ask where we are in this, I believe we are in the end of the first inflationary push, and we are now in the process of trying to battle that inflation. And it is driving. It will lead to some significant growth slowdowns, like we're beginning to see. As that happens, inflation will come down. It will probably get to 1.5%, and we will declare victory. We've already tried to declare mission accomplished here in December. I believe the Fed will be forced to pivot. This is an election year. That's very relevant to the macro conversation. It's relevant to 68 to 82 as well. During those election years, during that period, we saw greater than 20% returns in markets, double digit every time, 21% on average. Those were because of massive fiscal and Federal Reserve support during that time. I believe we will see that again, but in the context of that, we saw 0% nominal returns, 70%, 67% negative real returns over that time period. And I do believe this is a very poor time for equities broadly, in a bigger macro picture, despite what is likely a positive year within the context of that. So we'll stop there and I'll let you ask some more questions, but that's the big broad macro framework in 5 minutes.
You mentioned the 70s, which is everybody's worry right now. Do you think you mentioned some similarities. Do you think there's some major differences as well between now and the 70s?
Absolutely. It rhymes, right? Because of this inequality and the populism that's a result of it. But market structure is very different. And we've talked about this, but there were no, derivatives were just being launched in the early 70s, right? They weren't, there were no structured products. This market is a very different type of market than it was, when we had that last similar political reality. So I think that has a major feedback loop. We've talked about how dispersion has been driven by structured product supply and vol compression. That has a feedback to that equity complex, which helps support the equity complex and can extend cycles longer than they used to be and reduce volatility. I think that's a critical, important point. The other one is, a lot of people talk about this. I think this is less important in terms of real returns. I think it'll affect nominal returns, but I do think that the two other things are very important. One, the U.S. debt, right, and how that will play into the reaction functions of government. We're at a very different governmental debt level than before. And then obviously we unpinned from gold in 71, and so that also had some distinct effects during that period that may be slightly different now that the Fed has more experience, more dominance, et cetera. So I would highlight those three things as probably the most important factors that are different, and that will help affect kind of some meaningful differences in how things react this time around.
How do you think about, for many years, we had these structural forces that were keeping inflation down. We had technology, we had demographics, and we had globalization. And at least that third one seems to be reversing now. But how do you think about all those in terms of like the structural inflation? Like you mentioned, we're going to have cyclical moves up and down, but how do you think about those in terms of the structural inflation we might see going forward in a longer period?
They're all related. So you said technology, globalization. What was the third one you said?
Demographics.
Demographics, that's right. So they're all related, right? Ultimately, if you look at what's happening demographically, we have a dominant baby boomer generation dying, right? So that's reducing labor supply. That's important. On top of that, we're getting financial support for people, which is allowing baby boomers to retire and stop working. Not to mention broadly, at large population. Globalization, as we talked about, is tied to protectionism or a lack thereof it. Populism is tied directly to protectionism, and that's leading to deglobalization, which we're seeing in global conflict. But technology, which people think is completely, divorced from all of this, like the AI boom, everything seems like, oh, we've never seen this before. If you think that you haven't seen the progress of time or understand how technology and expansion works, they happen as a function of investment. If you invest, which we did at 0% interest rates in duration, we allowed companies for 40 years, to go out and make no money, right? If you look at Amazon would not have existed. It's the biggest business in the world. I would argue it would not have existed if we didn't allow the corporation to not make money for 24 years. Uber, Tesla. I can go on and on about all of the corporations that didn't make money for over a decade and would never have survived in a period of higher interest rates. They just wouldn't have existed. Now that they're here, yes, that technology will continue to grow, but I believe it'll grow at a much slower pace than people expect because it'll lack investment. Much like we saw a boom in 97, 98, 99, 2000. We had a massive expansion. The internet was critical. It was important. It changed the world. Nobody ever had any doubts about that. But the irrational exuberance part that Greenspan talked about was the exuberance that anybody could make money, that it was just a free for all, and that you just threw money at it and you would win because the internet was so important. 96% of internet companies went bankrupt in 2000. 96%. The NASDAQ lost 91% of its value. I mean, AI is a critical change. Blockchain, critical. It is going to change the world. We will go to a metaverse at some point. All of these things will happen. But the pace at which it will happen will slow. And there will be so much losses profit-wise along the way that people are disassociating the importance of technology and the growth relative to the rate and the speed and the profitability of those things. So my view is that, yes, we're getting massive technological innovation. We always have, since the time the wheel was invented, but these are all, it seems like it's faster and more ridiculous than ever, but it's constantly that way. We're at an increasing rate of change. But that has always been the case. And I think that's important to note. So I think technology, and the advancement of technology will significantly slow as interest rates increase over time.
Just one more for me before I hand it back to Brent for the breadcrumbs that everybody I think is looking for. But I want to ask you about the Fed, because they are meeting tomorrow. They seem to be in a tough position right now. You've talked about them being in a box. Like, what do you think the Fed is going to do going forward? And what do you think they should be doing?
Well, what I think they should be doing and what they are going to do are different things. And what the Fed is going to do and what they're going to say are also probably different things. It's important to remember that the Fed has now said the word transitory 3 times since 2021. And in my opinion, not because they actually thought inflation was transitory. I don't think the Federal Reserve is stupid. I think they know they need to use their power of their verbiage to try and control as best they can the outcomes. And in telling, one of the biggest problems with inflation and these things is that it's self-fulfilling. If there are expectations of inflation, that pulls forward demand, right? And that increases inflation. If markets reflect an inflationary environment, then you can invest and you can buy things, real assets, with cheap interest rates. And it doesn't allow the Fed to keep interest rates lower. So there are natural consequences of admitting that we are in structural inflation. So the Fed won't admit it. The Fed won't. They're not incentivized to do that. They're incentivized to play, Pollyannish and stupid. They are fully aware of the circumstances. Now, when you're in a box and when you are happy to no longer just, the way things were set up before, we had structural deflation caused by 0% inflation. Again, we used to send money to what I call Planet Palo Alto. We used to keep sending money to supply. And that would create all these goods back onto our shore, right? We would get Ubers and Teslas and Amazons, and those are deflationary. And so the Fed was able to stimulate with monetary policy cyclically, right? To battle that. And so it was very easy in a deflationary period. They had one mandate, which is to just make sure growth hummed along. The cost of that was inequality, right? And we could keep doing that forever. It's a great system if people weren't in the system and we could just keep sending money to the top 0.1%. But we're not in that situation anymore. Now we have a dual mandate, that the Fed has a dual mandate that they have to battle. And so they have to choose at any one moment. And that is a very, at the high wire act. That's something we haven't seen for 40 years. The Fed is in an unenviable situation. And any given time, they're going to have to go from one side to the other. And it's probably most driven by politics because there's no right answer. What's worse, inflation or recession, poor growth? It's a political question. And so ultimately, when the political whims push towards growth, as they are during an election year, this is why we get positive election years in the context of what's otherwise a structurally weak period for equities and risk assets. But in these periods, you'll get stimulus, and they will favor growth over inflation. And I believe that's what they will be doing this year, and that's what they've told us as of December of last year. They were pretty clear. Took a lot of people by surprise. That's what they're going to do. Now, do they have to still kind of, when inflation continues to be hot 5 times in a row, do they have to kind of back off of that a little bit? Sure, it's a political story, and they can't be seen as ignoring inflation. But you better believe their interest, as soon as they can, is to try and continue to stimulate and make sure this economy continues to rumble along, and if not, be hotter than it would have been in other periods. So I believe that's where they are this year. Now, again, the next bout of inflation will lead to a abandoning of growth for inflation. And again, I think that will eventually come, but it's probably for next year.
Yeah, thanks. So nice to meet you officially.
Same, Brett.
There's been a lot of conversations about call overriding, let's just say fairly low equity volatility or the impacts of 0DT, whatever it is. But the SIBO pointed out that globally, vols are pretty low if you look at cross asset and global vol. And I'm curious, that was particularly the case in the end of March, start of April. And now we're starting to see like rolling bouts of vol picking up. Yen was going crazy. We had gold going crazy. FX, so vol seems to be having these spasms. And whereas, let's just say over the last year, things were fairly quiet. Do you think that's a trend that's going to kind of continue here as we move to the election and as things are changing with FOMC and those types of things tomorrow? Or is that likely to get, smoothed out into the election this year? Like, is there like a changing of regimes, I guess is the question.
So if we zoom out to 2.5 years, not just the last year, right?
Mm-hmm.
We have had significant dispersions in volatility, not just dispersion in equity markets, et cetera. That is, in my opinion, partially because interest rates, as they went higher, right, increase risk premia and are naturally supportive. And not to mention we have, rotations due to changes in the world right now. Those are naturally, the interest rates increase is naturally supportive for that volatility. How I've described this is, and again, I know, Brett, you're familiar with this, but, the structured product issuance and the move away from equities into bonds, right? It used to be just a one-way street just into bonds. Now it's a move into bonds plus collateral that you can then use to compress risk. The interesting part is that compression of risk through structured products and other similar vehicles is going to the center of equity indexes primarily. That vol supply is really pinning, S&P vol and vol and central. That the FX world, right? That world, for example, is not as deep and does not have this type of supply, and it is really on the fringes. But yet at the epicenter of this deglobalization reality and the move of money. So FX, if you look at 1968 to 82, what vol did the best on a realized basis and an implied basis, it's not what people would think like oil and commodities. It's not equity vol. It's definitely, it's not even bond vol, which did quite well. It's actually FX vol. It's gold vol. It's the currency vol. The dollar vol was incredibly high, right? Those are the volatilities that are less likely to also be pinned by this supply. And we argued for this about a year ago when gold was on its lows and the vol was compressed in gold while oil vol was through the roof, right? Commodity vol actually did, like oil vol and other commodity vol did very, very poorly in the 60s and 70s, despite it being very strong because it was underpinned, instead of the Fed selling puts, which really, reduced the volatility of the dollar and bonds and all these things for 40 years. Now you have commodity producers able to sell puts and underpin price. So vol and those centers was actually very compressed over that time period. I believe that will also be the case in this time period, that whether it's oil or copper or other industrial metals, the volatility of those are sale. You should be selling puts in those. Best way to benefit from the uptrend there. Much like it was good to sell puts broadly over the last 40 years in a very profitable trade. In equity land, I do believe equity vol will not do that great. What it did in the 60s and 70s, which I believe it will do again, is you'll have spasms, like you were saying. You'll have short-term volatility. But again, I want to remind you, 68 to 82, 14 years, the market went nowhere. What does that do to long-term vol, right? Yes, you had a lot of declines. You had a lot of rallies. But at the end of the day, those were short-term spasms. And long-term vol was really did not perform. And so one of the best trades you could have done, 68 to 82, was to sell calendars all day long, and just keep selling them because it would mean revert, and it kept mean reverting again and again now. And that way you'd have the gamma, but the Vega would not perform. And I do think that's likely to be the case. I also think skew, which we've seen at very low levels lately, right, that's actually efficient. I think skew is overvalued in this regime. I think you'll see a much flatter skew going forward, despite these short-term spasms. I think it is because long-term vol and long-term skew is the most overvalued of all. You'll begin to see a significant reduction of skew, I think, structurally going forward.
So I think sort of somewhere related to that may be the upcoming election. And I just wanted to get your insights on volatility into and around the election. There's obviously a bunch of kinks in kind of term structure if you start to look at that. What, from a volatility perspective, do you think the election impact is? I mean, people are obviously anticipating more volatility around the election. I remember in the last election, there was some pretty wild movements, or something 2 years back of the Trump election. What are the effects? Are there knock-on effects that we can start to look at now? Are we still a little bit too early before the election period, and how vol may impact things? How do you start, or when do you start to think about those?
Yeah. So in terms of the event vol tied to elections, it's still pretty far out, right?
Mm-hmm.
It's not nearly as liquid and hard to make any money now, nor do you need to be positioning for that now, in my opinion.
Mm-hmm.
That said, elections and event vol are a critical part of market microstructure, and drive short-term are one of the biggest inputs to short-term moves. The world hedges for events. Time is not linear in the sense that a second is worth this, same amount of volatility. Basically, we can have weeks where vol is very compressed, and there are no hedges, and there's no big structural buyback of some of the deltas tied to that in the equity market. And then we can have a massive day or two where months of implied volatility come out of the market. So the election is always a hedged event, a watched event, which means dealers take naturally massive insurance on it and are short stock. In the absence of some really unexpected outcome, right? And just a marginally unexpected outcome is not the same thing. And it's hard in an election where there's two people, right, to have a dramatically unexpected outcome. It can happen. But it's not just the president that matters. It's the government and everything that comes with mandate. So at the end of the day, those tend to be positive events. People get bearish, get scared. But again, there tends to be very positive support coming out of that. And I think, over a short period. Now, that doesn't mean that's positive for the next year or 3 months even. It really, coming out of that maybe for that option cycle, in a month or so. Now, a squeeze out of that period, into the end of the year. It's in November, early November, right? Then we have some of the most seasonally positive periods that also bring supply and have other, we have the December expirations are always the biggest expirations. They have a lot of other positive flows coming out of it. So I would expect this year, the post-election to be very positive, as particularly in an election year. There'll be some exuberance. Now, to be clear, my view on after this year, how this market looks is, it's set up for potentially after a big rally, a very dangerous setup here structurally. And when you zoom out to a more 5-10 year picture. So it makes sense after a big rally this year to start to see something I would expect in January or February of next year as a potential target. If we do rally like I expect, to really be placing hedges and thinking about the next move.
As we wrap up in the couple minutes we have left, we have a standard closing question we're asking everybody today, which is, what is one interesting thing you're seeing right now that you think others should be paying more attention to? And it could be inside or outside investing.
Yeah, I think there's so many interesting things going on right now, but I think the thing that people really aren't talking enough about is skew, and how flat and how compressed skew is in the market. As we talked about, I think structurally that makes a ton of sense. But there's also some very important reinforcing realities of that circumstance. It means it's very easy to hedge any tail downside, and it makes declines in the market easier to buy. That doesn't mean that we are going to turn around quickly into whatever decline or swoon we've seen, but it does mean that the decline is likely to not be structural, and at some point, also not meaningfully catastrophic or a vol event. I think that's very important. It is way too easy at this point to get hedges in the market, and I think that's a very, very important thing that people are missing. Now, to be clear, a lot of times when skew is flat, declines can last a bit longer than expected, right? Because you don't get that impulse, that fear impulse, and you don't have that vol spike that then leads to that buyback that we've talked about from the Von and Charm flows. So ironically, if you go look at the timeline, 2015, we had the yuan devaluation, big vol event, screens went black. That was a big vol event, not a very big decline, all in about 8-9%, followed by Feb 16, which was the opposite, right? A very vol compression, skew flat decline. That was the biggest decline we had since 2009. And it was 12.5%, right? But not a vol event, but more tick, 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 tick. Similarly, you roll forward to 18, we had the volpocalypse, not that deep a decline, right? But very, very meaningful. Got about 9% decline. And then but quickly responded. What happened in Oc, Nov, D's 2018, skew flattened. People were hedged because of the last event. And what happened? We had a 19% decline. And people talk about the volpocalypse and the fear of it. It's less than half the decline of the Oc, Nov, D's decline in 2018. So you can get bigger declines with flat skew because you don't get that vol reaction and that feedback loop to feedback. But ultimately, they do tend to be buyable dips, and do tend to eventually resolve themselves. It just may take a bit longer. So I think the skew out there is telling you something. I think if you look at history and the circumstances of that skew, you'll have a better clue about how this next several months will play out.
Well, Cem, thank you again for doing this. We really appreciate you taking the time and coming out to help us support Susan G. Komen.
Couldn't think of a better cause, and couldn't think of two better people to do it with. So I appreciate you guys having me. Take care.